All right, today we are breaking down a really fascinating quarter from Worthington Steel. Now, on the surface, their earnings looked like a miss. And yeah, the stock dropped pre-market. But by the end of the day, it had rallied all the way back. So, what did the market see that turned an initial dip into a story about strategic success? Let's get into it.
Okay, so here's the puzzle, right? The stock gapped down right after the numbers came out, which, is exactly what you'd expect on an earnings miss. But then it clawed back every single penny and then some. This is the kind of price action that tells you there's a much deeper story going on, and that's what we're going to unpack right now. So first, let's just establish the headline numbers that kind of spooked the market at first. On the surface, it definitely looked like a clear miss on the bottom line.
And here it is. Adjusted earnings per share came in at 38 cents. That was a pretty big miss, almost 21% below the consensus estimate of 48 cents. In a knee-jerk market, a number like that is usually more than enough to send a stock down for the whole day.
But here's where the plot thickens. While earnings missed, the revenue was a massive beat. We're talking nearly $872 million in sales, which just crushed the implied estimate by over 11%. So you have this conflict, right? A bottom line miss and a top line beat. And that's where the real story begins.
So why was that revenue beat so incredibly important? Well, the market figured it out pretty fast. This wasn't just about selling more stuff. It was about the quality and the profitability of what they were selling.
And this is the crucial point right here. It's this strategic shift in their sales mix. They're doing more higher margin direct sales that now makes up 65% of their business. That's a huge jump from 55% just 1 year ago. It means they are laser focused on more profitable work, which is exactly what long-term investors love to see. And you can see exactly where that high quality growth came from. Direct shipments to the auto industry, up 26%. And look at energy, up a staggering 50%, thanks to a boom in solar projects. That strength more than made up for the cyclical weakness they saw in construction. Management really drove this point home on the earnings call. The CEO, Jeff Gilmore, basically said this wasn't just the market lifting them up. No, they are actively out there taking market share, winning brand new business with major car companies, and cementing their spot in these key growth markets.
And this brings us to a third key point. Beyond just a single strong quarter, the market was also clearly buying into management's long-term vision. They laid out a really clear roadmap for where this company is going.
And these are the pillars of that strategy. They're expanding their electrical steel capacity to get a piece of that massive EV and power grid boom. They're using AI agents in their back office to find real cost savings. They're keeping their eyes open for smart acquisitions, and they're pushing hard on innovation.
And here's a perfect example of that innovation. This new patent-pending bonding technique. I know it sounds technical, but it's a direct shot at the EV market. It's designed to make electric motor cores better and cheaper to build. That's a tangible technological edge in a super high-growth industry.
Okay, this was a really critical moment on the call. The CEO didn't just talk about making changes. He committed to putting a number on it, promising a future scorecard to actually track the savings from these initiatives. That gives investors something concrete to measure their progress. It just signals a ton of confidence and accountability.
Okay, so with all of that context, the quality revenue, the market share gains, the clear long-term strategy, let's go back and look at how the stock actually traded on the day. I mean, these numbers just tell the whole story. The stock opened down over 4%, a direct reaction to that EPS miss. But as the call went on and the market started to digest all these details, it staged a massive reversal, hitting a high of over $38 before closing slightly positive for the day. Just a huge turnaround. And get this, it wasn't some sleepy reversal on low volume. This happened on double the stock's average daily volume. That is a huge signal of conviction. It means buyers were stepping in with force, believing that the long-term story was much more important than the short-term headline number. So the takeaway here is pretty clear. Investors looked right past the noise. They saw a company that was successfully shifting its business toward more profitable areas, winning in critical markets, and executing a clear long-term plan. They valued the strategy over the stat. So where do we go from here? Let's look ahead. Here's our take on what to watch for as Worthington Steel heads into their next earnings report. For the third quarter, we're modeling a rebound in profitability. We see EPS coming in around 52 cents on revenue of $895 million. We think that momentum in market share is going to continue, and we expect a slight improvement in their margins as some of the pricing pressures in galvanized steel start to ease up a bit.
Based on all this, we're initiating our coverage with a market perform rating. Now, look, we are super impressed by the strategic progress, but the stock's powerful reversal means a lot of that good news is already reflected in the price. We're going to be watching for them to deliver on that transformation scorecard to justify a higher valuation from here.
And now for our outrageous but plausible trade idea. If you want to bet specifically on Worthington's execution, you could consider a pairs trade. Go long on Worthington Steel while shorting the VanEck Steel ETF, ticker SLX. The whole point here is to isolate the company's own story from the ups and downs of the broader steel commodity cycle. The catalyst? That scorecard they promised. If it finally quantifies their efficiency gains, that could force the market to re-rate the stock higher than its peers. The main risk, of course, is a massive rally in all steel prices, which would obviously hurt the short side of the trade.
And a final reminder, this is for informational purposes only and is not financial advice.